Jenny, Denis, and Peter, it's really nice to catch up with you. You're all with KPMG in Australia. Jenny, you're a director in deals and legal. Denis and Peter, you're both partners in the international tax practice. So I really wanted to catch up with you because the Australian federal government just released its first budget. And I know that transparency, amongst other things, but transparency has been a big focus in Australia for quite some time. Tell me what was announced and how does it fit in with existing transparency rules?
Sure, thanks, Rodney. So on the night of the federal budget, the government proposed new public mandatory country-by-country reporting obligations, so that large multinationals that are significant global entities, which generally is groups with annual global income of $1 billion or more, are required to prepare country-by-country information, as well as a statement of the approach of taxation. So that's essentially like your tax strategy. At the moment, it's not mandatory to publish your tax strategy or your approach to tax, but the government has announced that they will make that mandatory along with country-by-country reporting. The effective date of that is 1 July 2023, which I think it applies to income years on or after 1 July 2023. Now, that means Australia will join a growing list of countries around the world that are proposing mandatory country-by-country reporting. The EU CBIC, they've got a new directive there, as you know, and I actually heard that the US may be proposing some CBIC proposals, but it's unclear whether that will be approved. So that's the direction Australia is heading. What we don't know at this stage is the form in which the country-by-country reporting, what standard or framework will apply. I understand that the government considered various frameworks, like, for example, they've considered, we've got the OECD CBIC framework, but that's only publicly available, that's privately information you give to the tax office only, it's not public. Then you've got the EU directive, and the EU directive is country-by-country reporting in EU member countries, blacklisted countries, and then there's a clump of the rest of the world. That's the way they aggregate. Now, then there's the other standard, which most of you have probably heard of, is the Global Reporting Initiative 207. Now, that's considered the gold standard in reporting on ESG matters more generally, but there's also a topic-specific standard called GRI 207. It's a specific standard to report tax information, with the ESG type flavour. Now, if you have a closer look, if Australia went down the path of GRI 207, and it's that's not it is possible Australia could go down that path. There are four aspects within GRI 207. You can split into two. There's quantitative and there's qualitative. The qualitative aspects require a company to talk about, for example, their approach to tax. So that's essentially the tax strategy. Then they've got their approach to tax risk management, tax governance framework, how you approach external stakeholder engagement, your approach to public policy. So that's all the narrative form of your GRI 207. And if Australia went down that path, there's the GRI 207-1, as I understand, that goes through that, sets out the requirements of what your approach to tax is. Then the quantitative aspect is the country-by-country reporting, and there are specific data points that companies will need to report if they apply GRI 207. Which is similar to the OECD country-by-country reporting. Disclosing things like your related party dealings or, and your unrelated party dealings. But the difference with the GRI 207 is that on a country-by-country basis, it requires the disclosure of permanent differences. And the reason why it shows that, it's so that, things like tax incentives, tax settlements, or anything that's of a permanent nature, shows up in country-by-country reporting, and that's the information that investors want to see. as well. So, but like I said, there is not enough detail at the moment of the framework of country by country reporting in Australia, but I wouldn't, I think GRI 207 path could be the way Australia could be heading.
That's quite a lot of stuff, Jenny. And so as you talk to people about what they should be doing, what should people be thinking about doing in this space now?
I think at the moment it's early stages. We won't get legislation until the first quarter of next year. But I think whilst country by country reporting may be it's probably easier for an Australian multinational with outbound investments to do the reporting and perhaps collect the data points. But if you're an inbound, so if you've got a US parent company with Australian subsidiary, the question there is, well, is the Australian government going to mandate country by country reporting, in scenarios for inbound multinational, inbound Australian companies, foreign-owned companies, and if so, how would that work? And I think companies need to assess that in particular impact, whether that's feasible or not, and feed that into the consultation process at this stage. So I think that would be the immediate step. Now, for the Australian outbounds, there are already some Australian companies, particularly in the resource industry, that are already complying with country by country reporting, standards like the GRI 207. And the reason why they are already complying is because they are in the resources industry, and it's mandated by the virtual fact they're part of a international, mining council or advocacy group, that sets performance expectations for them. Some people are already doing OECD country by country reporting that information to the tax office. But then there's another step you need to take to say, well, if we need to make this public, what extra, steps or assurance processes do we need to do in terms of making that information public?
And I suppose actually that's probably a large part of a business's thinking, right? Like, what is it that we should be disclosing? How should we go about disclosing it in a way that it can't be inadvertently misinterpreted by readers?
Well, yeah, that's right. So we've got the country by country reporting, and the question is that useful information to, your external stakeholders, and could it be subject to misinterpretation? I know some companies in Australia, yes, they do country by country reporting, but does that tell you the full tax story of your organisation?
Yep.
Now, the limitations of, for example, if you head down the GRI 207 path, is that it only requires you to report corporate information. You could pay a whole heap of other taxes, that are, you could make, make payments on other taxes that are not disclosed. So the question there is, well, should you do a separate, should there be another, a report, should it be incorporated as part of your whole tax transparency report to give you a better picture of your tax story?
Got it. Yeah. Got it.
So that's quite a lot. You might have a situation where companies need to actually think about multiple types of public disclosures and reporting here in order to get across the full picture.
Yes. Yes, exactly right.
So that's really interesting. So that really talks to sort of thinking strategically about what it is you plan to do well before you actually have to kind of do it.
Yes. Now, some of the companies that are already doing C-by-C reporting, the next phase for them is, well, if this is going to be an ongoing annual compliance sort of process in the same way as tax returns, is there a way for us, to automate that process in tax transparency reporting and C-by-C reporting to make things easier? And that comes down to, efficiency of the in-house tax function and, solutions like that for automation. So, it's another system redesign, I think.
Got it. So that's actually kind of a pretty big area for people to get their arms around, this whole question of transparency.
Yeah, there's a big change about to happen in Australia, I think, and people haven't realised yet. So, yeah.
Yeah. And then I wanted to ask also, I understand that the ATO has a focus on royalties and intangible assets. Can you tell me more about that?
Thanks, Rodney. So you're right, the ATO has had a focus on this for some time now, and there's been a number of guidance products that have been issued over the last few years dealing with mischaracterization of royalty payments, so what we call embedded royalties, where, for example, there might be an intangible payment embedded into a tangible product, and obviously not then paying royalty withholding tax appropriately on those amounts. Likewise, there's been guidance around, and this is draft guidance still, around software royalties, and especially payments by software distributors. So updating a very, very old public ruling from the 1990s, which still dealt with floppy disks, obviously into the modern era. So obviously very much overdue, but there's obviously a consideration as to, well, how does the modern world of how we disseminate information and software sort of work in with these concepts of royalties and intangibles, both in our domestic law, but also in our treaties. And then finally, the ATO has also issued some taxpayer alerts around the use of tax treaties as well. So picking up that point around obviously getting a lower rate when maybe there's not a real entitlement to it. So consideration of the principal purpose test in a number of our treaties, especially through the multilateral instruments. So all in all, there has been a significant focus on this. I think the ATO sees that as being really a sort of a key area where there may well be an underpayment of tax, or there may well be people not paying what they call their fair share of tax. So there's been a number of different ways in which that's tried to be addressed, both, as I said, through sort of modernising the approach with things like software, also understanding the payments and what really is being paid for. Is there a royalty element in something which would not always initially appear to be a royalty? And then finally making sure our treaty process is tightened up. So it is certainly an ongoing feature, and almost to Denis' point again, it very much requires taxpayers to understand both what they're doing in terms of what they're paying for, but also to whom are they dealing with? Are they dealing with an entity which has got sufficient substance to be able to use a tax treaty as well?
So it certainly sounds like a tightening of rules in that space for people that perhaps haven't been focusing on them. But tell me a bit more about what the announced measures actually are, and how do they compare to internationally accepted rules? And just to pile on with that, what does that mean for us as a practical matter going forward? Oh, Peter, you're on mute.
Trap the young players. So, Rod, it's a few things. So there is a new proposal around payments in respect of intangibles. And that's not defined in the announcement, but it was a policy measure the government brought because we have a new government, and we did have some consultation with Treasury prior to the budget. However, it's still unclear exactly how that will apply. We do expect it will obviously be broader than royalties, but whether it includes things like management service fees or other type of things where there's a royalty element embedded, but other intangible related aspects of the payment. Where those payments are made by significant global entities, which in Australia is basically an entity that's part of a group with Australian $1 billion of income, then if they're making such payments offshore to a jurisdiction that has a low tax rate, and the low tax rate for this measure will be 15%. It's not clear whether that be headline rate or effective tax rate, but if there is a low tax rate as such, or if it's paid offshore to a tax preferential patent box regime with insufficient substance, and again, that isn't defined either, then the proposal is to deny deductions for the payment going out of Australia. So we know the general direction of the proposal. We don't know the specifics of how broadly it will apply in terms of types of payments or how you'll measure that tax rate in foreign countries. It does reflect Australia in a number of aspects in recent years with international integrity measures has gone beyond some of the norms. So for instance, when we brought our hybrid mismatch rules in, we have a similar type of finance integrity rule for interest or payments on derivatives that go offshore to low tax jurisdictions, in that case 10%. Different rate here, but similar thing now looking at intangibles. When Treasury was consulting on this, they did include examples of the UK's regime that it has. It's got an ORIT regime, I think it's called, which looks at payments going offshore, or the Netherlands also has a similar regime looking at royalties going offshore. What we've got seems to be a bit of a blend of both, and it doesn't include carve-outs for substance overseas. It doesn't carve out countries that Australia has a treaty with. It doesn't, from what the announcement said, contain any type of purpose test, which many people had thought would be present. So, so it seems to have picked some aspects up of some foreign regimes and not of others. And perhaps concerningly, that does leave a lot open, I think, to either what's defined in the legislative process or the regulator's interpretation when the tax office looks at this and starts to apply it in practice. Denis, I know you have similar thoughts to myself.
That's right, Peter. I think that last point's a very valid one. One of the points that Peter has mentioned is it's both a sort of direct and indirect payment concept as well, at least in what we've seen so far. And Rodney, taking back to some of our other experiences with how rules are implied, and certainly Peter mentioned there the hybrid mismatch rules, where we have the importing payment style concept. There's a question probably out there as to how are we see it being implemented by the Australian Taxation Office here in terms of tracing through layers potentially to understand if it's being paid ultimately to one of these low tax regimes or preferential patent boxes, as Peter mentioned. So I think it comes back to this point Peter raised around not a lot of detail right now, but it will be very interesting to see how that happens in practice.
That actually sounds kind of significant, and presumably it means people are going to need to look through their structure to understand where these flows are. When are these rules anticipated to be effective from?
Applied to payments made on or after 1 July 2023, so it's not far away.
Not far away.
And yeah, Rod, you're absolutely right. Our concern here is it will be another thing that will require a very detailed tracing and documentation exercise in filing Australian tax returns that multinational groups have experienced under our hybrid mismatch rules, the importer mismatch rule. So our concern is that this will add to that compliance load and the amount of work that needs to be done in order to file a return.
Well, fascinating. So 2 big things already in the budget: transparency measures and really a focus on cross-border intangibles. Was there anything else announced in the budget that might affect multinational businesses doing business in Australia?
There were, Rod. So we've also got a change to our thin capitalisation rules, which was announced in our budget. So we're moving away from our usual asset-based safe harbour test to a more an earnings stripping rule, which we've seen in other parts of the world. In addition, our proposed changes to what's called our worldwide gearing test and also our arm's length debt test, which in particular will focus and probably have an adverse impact on certain related party debt as well. The other measure which we saw in the budget, which was probably less expected because the intangible measure and also the thin capitalisation had been foreshadowed, as Peter mentioned, through consultation, was a sort of crimping of listed company share buybacks as well, and the ability to attach imputation credits to those listed company buybacks. So that was probably a bit of an unexpected measure, and that will probably have quite a flow-on effect to capital management strategies for a lot of listed companies in Australia. In addition, the federal government did also announce some measures which had been previously announced in previous budgets that would not be taken forward or would either be deferred. Many of those were on issues around, say, our debt equity rules and some of our taxation of financial arrangements rules. So it's pleasingly one thing that wasn't in that list of measures that won't be going forward was a change to the tax residency rules. So the Australian corporate tax residency rules have been in a bit of a state of flux after an important court case a few years ago and a change of approach from the Australian Taxation Office. In the 2020 budget, the former government announced that there would be an amendment to the residency rules. It looks like that has, at least in the immediate term, survived that. And so that we still expect to see that going forward at some point, which I think will give some very welcome certainty to a number of multinationals operating both in Australia and then out of Australia as well.
So, folks, that's a lot of stuff announced in the budget then. Big things on transparency for people to think about. Renewed focus on intangibles, a new earnings stripping or debt financing type regime, and dealing with company buybacks. Just a lot, I guess, for folk to focus on, and not a lot of time because some of those rules are coming in soon. So look, thank you very much for your time. This is really timely and really interesting. So thank you again. And it's really nice catching up with you.
Thanks, Rod.
Thanks, Rodney.